Hello and welcome to our monthly catch-up with the Switzer Dividend Growth Fund with the Portfolio Manager, Shawn Burns. Thanks for joining us, mate.
Pleasure, Pete.
All right, Burns, you tell us how we performed over the month.
We're higher, and I think what we see over time is in strong bull markets, the fund does well, but lags the market, and we're hoping that if the markets are lower, that we outperform in down markets.
Yeah, and the reason for that is that the Switzer Dividend Growth Fund is more dividend chasing than growth chasing. Growth is like cream on top of the cake, isn't it?
That's right. We have a quality and yield focus, and that's what drives the performance, and we're sticking to that.
Okay, so I guess to justify that statement, I should ask the question: how has Switz performed since inception in terms of both income and capital growth?
Well, because it's a dividend yield fund, the yield is an important part of the total return. And I think if you've reinvested your dividends since inception, your share count is up over 12%, higher, more shares. And you can see that over time, reinvesting the dividends adds a lot more to the performance of the fund.
Yeah, and we have a chart that basically shows it, where the red line shows the impact of the reinvesting of dividends over that period of time.
Yes, and that's because dividends are a big part of the fund. We do look to pay out a lot of dividends, and we chase dividends and invest in quality, high-yielding stocks. Yep.
So what effect do lower interest rates have on a portfolio like ours?
You'd think positive, and it should be positive. The proviso is interest rates are going lower because of lower activity. So we'll just see what the impact on profits are, and the type of quality stocks we invest in, we're expecting some impact but not huge. We just to see how, and that'll probably be a temporary thing while the economy lags the drop in interest rates before it recovers out through the other side. So we'll see how that goes, but it is positive.
Yeah, but a lot of companies hesitate cutting their dividends unless they've got a really strong reason to do so.
It'd have to be, that's exactly right, Peter. Yes, they will look to maintain dividends, and that's what, and especially with the balance sheets being so strong at the moment, and the companies that we invest in, they're big, strong companies, cutting dividends would be last resort. Okay,
so what's the outlook for the portfolio with the election out of the way and interest rates heading downwards?
Lower interest rates and increasing profits is a good combination for equities. The way our portfolio is positioned, it's Australia heavy. So having the election go the way it did, I think is a good thing. Lower interest rates over time will be a good thing. We just have to get through those short-term blips as the economy bottoms. Housing looks like it may have bottomed. That's a good thing. Consumer confidence may bottom with it. So looking forward, I think that probably it's from an Australian point of view, probably the best outlook we've had in probably 18 months.
Shawn Burns, thanks for joining us.
Pleasure, Peter.
That's Shawn Burns, Portfolio Manager for the Switzer Dividend Growth Fund. I'm Peter Switzer.